It's a Wednesday night. You're sitting in your car outside a store, staring at your banking app. You're calculating whether the few items in your cart will push your account to close to zero. Toothpaste, laundry detergent, a small birthday gift. Nothing extravagant, just normal life. At the same time, someone you know just posted vacation photos online. Same job, same salary, same city. Yet somehow their life looks completely different. You start wondering, are they secretly wealthy? Are they buried in debt? Or are they doing something you never learned? Let me tell you something uncomfortable. The difference usually comes down to one quiet financial decision most people ignore. Most people believe wealth starts when you hit six figures, or when you become a millionaire, or when you suddenly earn enough money to finally begin investing. That belief sounds logical, but historically it's not what builds wealth. Financial stability rarely begins with a massive salary jump. It often begins with a boring, repetitive action that feels too small to matter. Not winning the lottery, not picking perfect stocks, not timing the market, just consistent investing. I know that sounds simple, maybe even disappointing. We've been conditioned to think wealth requires secrets, hidden strategies, special access. But the truth is far less exciting and far more accessible than most people realize. There is a powerful financial threshold most people overlook. It's the moment when your money begins working harder than you do. For many people, this process begins with steady contributions into broad market investments over long periods. Not aggressive trading, not complicated strategies, just consistent participation in long-term market growth. History shows that broad stock market indexes have produced average annual returns around 10% before inflation over many decades. After inflation, roughly 7% remains. That growth doesn't happen overnight, but over decades it creates exponential momentum. Think about what that actually means. You contribute money, that money grows. The growth itself grows, then the growth on the growth grows. This cycle continues without requiring additional effort from you. The key is consistency, not intensity. You don't need to invest large amounts. You need to invest regularly, month after month, year after year, through good markets and bad markets. That repetition is what unlocks compounding power. Here's where things get interesting. The biggest obstacle to wealth is rarely income. It's psychology. Human brains evolved to prioritize immediate rewards. Spending money today feels real. Saving for retirement feels abstract. 40 years feels invisible. There is something called present bias. We naturally value current comfort more than future stability. That doesn't mean people are irresponsible. It means our brains are wired for survival, not long-term compounding math. Our ancestors needed to secure food today, not plan for retirement decades away. That survival instinct still exists in modern life. It's why a new purchase feels satisfying immediately, while contributing to an investment account feels like watching money disappear. But once someone understands that delayed rewards can multiply exponentially, their relationship with money changes. Spending decisions begin to include future consequences. You start asking different questions. Not just, can I afford this? But what is this costing my future self? That shift in thinking changes everything. Let's look at how time changes everything. Imagine someone invests a fixed amount monthly into a diversified market fund for 40 years. A large portion of their final wealth typically comes from market growth, not their personal contributions. Here's a simple example. Someone invests $500 monthly starting at age 25. By age 65, assuming historical average returns, they might have over $1 million, but their total personal contributions would be around $240,000. The remaining wealth came from compound growth. In long-term compounding scenarios, early contributions carry more weight than later ones. Money invested in your 20s has decades to grow. Reinvest dividends and multiply repeatedly. Now imagine someone else waits until age 35 to start investing the same amount. They invest for 30 years instead of 40. Their final wealth would likely be significantly lower, even though they only delayed 10 years. Studies comparing early investors versus late starters consistently show that starting earlier often produces stronger results even when total contributions are lower. Time is not just helpful. Time is the main engine. That 10-year difference represents decades of compounding lost forever. You cannot buy back time in financial markets. Once a year passes without investing, that opportunity is gone permanently. Long-term investing is less about intelligence and more about identity. People who successfully build wealth often stop seeing investing as something they try when convenient. They see it as part of who they are. They automate savings. They remove daily decision-making. They treat investing like paying rent or utilities, something that happens regardless of mood or market news. Think about how you pay your phone bill. You probably don't debate it monthly. You don't check market conditions before paying. You don't ask whether it's the right time to pay your utilities. It just happens. Successful investors treat wealth building the same way. Automation works because it bypasses emotional decision-making. When money is transferred automatically, consistency becomes effortless. You're not relying on willpower. You're not fighting temptation. You're simply allowing a system to operate without interference. This removes the emotional burden of investing. Markets will rise and fall. News will be good and bad, but your system continues regardless. Another invisible concept is opportunity cost. Every dollar $50 spent carries an alternative future. Money spent today cannot grow tomorrow. This doesn't mean people should never enjoy life. It means understanding trade-offs. A recurring expense may feel small monthly but can represent significant long-term value if invested consistently. Consider a subscription service costing $50 monthly. That might seem minor, but invested consistently over 30 years, that $50 monthly could grow to over $60,000. Opportunity cost is not about guilt. It is about awareness. You get to decide what matters most. Maybe that subscription genuinely improves your life. Maybe it doesn't. But understanding its true long-term cost helps. You make informed decisions rather than automatic ones. Some expenses are worth their opportunity cost. Others disappear from your life without being missed. The difference is intentionality. Many people focus on small daily expenses while ignoring major financial decisions that shape long-term outcomes. Housing choices, car purchases, lifestyle upgrades after salary increases. These decisions typically influence financial futures far more than occasional spending. Saving $5 on coffee matters far less than choosing a home that costs $200 less monthly, or buying a reliable used car instead of a new luxury vehicle, or maintaining your current lifestyle when you receive a raise. Large recurring commitments create long-term cash flow pressure. Smaller, flexible expenses can usually be adjusted without long-term contracts or debt obligations. Research repeatedly shows that managing large, fixed expenses has a stronger impact on long-term savings rates than eliminating minor discretionary purchases. This is where financial energy should focus, not on guilt about small pleasures, but on major structural decisions that determine how much money remains available for investing each month. Financial stability changes career behavior. People with savings and investments often experience greater freedom when making professional decisions. They can negotiate salaries confidently. They can change jobs without panic. They can avoid staying in unhealthy work environments purely for financial survival. Money itself doesn't create happiness, but financial flexibility reduces stress and increases decision freedom. When you're living paycheck to paycheck, every career decision feels dangerous. Asking for a raise risks rejection. Changing jobs risks instability. Speaking up about workplace problems risks termination. But when you have months or years of expenses saved and invested, those fears diminish. You can negotiate from strength instead of desperation. You can pursue opportunities that align with your values instead of just accepting whatever pays the bills. That freedom can influence career growth, entrepreneurship opportunities, and work-life balance. Financial security doesn't solve every problem, but it removes certain problems from the equation entirely. There are several patterns that slow wealth building. One common mistake is waiting for the perfect time to invest. Markets rise and fall unpredictably. Long-term investors historically benefit more from consistency than timing. Waiting for the market to drop before investing sounds smart, but it often means missing years of growth while waiting for the perfect entry point that never arrives. Another mistake is frequent trading during market volatility. Emotional reactions during downturns often lock in losses and prevent participation in recovery periods. When markets drop 20%, fear pushes people to sell. Then when markets recover, they hesitate to buy back in. This pattern captures losses while missing recoveries. A third mistake involves ignoring fees. Small percentage differences in investment costs can accumulate into substantial differences over decades. A fund charging 1% annually versus a fund charging 0.05% might seem trivial, but over 40 years, that difference can cost hundreds of thousands of dollars in lost wealth. Understanding costs, consistency, and patience dramatically improves long-term outcomes. Every financial decision quietly moves someone closer to or further from long-term independence. Lifestyle inflation is one of the most common hidden challenges. As income rises, spending often rises at the same pace. Without intentional planning, higher earnings do not automatically produce higher savings. Someone earning $40,000 annually might save 5%. Then they earn $80,000 and still save 5%. Their absolute savings increased, but their lifestyle absorbed the rest. People who intentionally increase savings rates during income growth periods often create strong long-term financial momentum. Instead of upgrading everything when income rises, what if you kept living the same way and invested the difference? That approach accelerates wealth building dramatically. Momentum in finance behaves like pushing a snowball downhill. Early progress feels slow. Later progress accelerates rapidly because previous growth continues multiplying. The first $10,000 takes significant effort. The first 100,000 takes even more. But reaching your second 100,000 happens faster than your first. And your third happens faster than your second. That acceleration is compounding in action. There are always two versions of the future waiting quietly. One version includes financial stability, flexibility, and reduced stress about unexpected expenses. Another version includes extended working years and limited financial choices. Both outcomes usually begin with small, repeated decisions made decades earlier. Wealth building is rarely dramatic. It is quiet, gradual, often boring, but extremely powerful over time. Nobody gets rich overnight through consistent investing, but millions of people have built substantial wealth over decades using this exact approach. The most important step is not complexity. It is consistency. You don't need to understand advanced financial theory. You don't need to pick individual stocks. You don't need to time markets perfectly. You need to start. You need to continue. You need to let time work. Because the mathematics of compounding never pauses. It continues whether someone participates or not. The question is simple. Will you participate, or will you watch from the sidelines while time passes anyway? That $500 monthly decision won't change your life tomorrow, but 40 years from now, it might be the most important financial choice you ever made.